on March 14, 2023, in New York City. A pivotal incident occurred at Apex Trading Solutions, a prominent firm specializing in automated trading algorithms. The company managed a vast array of digital trading systems that leveraged complex algorithms to execute trades on behalf of its clients across various exchanges. These systems were designed to respond rapidly to market conditions, utilizing vast data sets and machine learning techniques to optimize trading strategies. On that particular day, a seemingly minor modification was made to one of the company's core trading algorithms. This update was intended to increase the algorithm's efficiency in responding to market trends. However, a critical technical failure surfaced due to a misconfigured access vector. The update inadvertently created a feedback loop where the algorithm began to trigger further sell orders based on its own declining stock predictions. The modification went unchecked because of an existing process gap in the company's deployment protocol, which failed to incorporate thorough post-deployment testing in live market conditions. As the feedback loop escalated, the trading algorithm began to offload shares at an alarming rate. Within the first hour, Apex Trading Solutions executed nearly 2 million sell orders across various stocks, worth an estimated $150 million. This sudden wave of selling pressure triggered a cascade effect among other algorithmic trading systems operating in the same market space. As other systems detected the rapid decline in stock prices, they too initiated sell orders to mitigate perceived risks. Consequently, within the first 2 hours of the market opening, the major indices fell sharply, with the S&P 500 dropping over 5% and wiping approximately $300 billion off the market valuation. Early reactions within Apex Trading Solutions were marked by confusion and a scramble for information. Internal channels were flooded with queries from team members regarding the abrupt market movements. A series of urgent emails circulated among key personnel, highlighting the anomalies detected in real-time trading volumes and price volatility. Some team members speculated about a potential market manipulation incident, while others raised concerns regarding the integrity of the updated algorithm. Initial responses included attempts to implement partial fixes by temporarily disabling the compromised trading strategy. However, these efforts were hindered by the system's interdependencies, which created uncertainties around the consequences of halting trades mid-transaction. At the same time, external signals began surfacing. Users of the Apex trading platform began to report unexpected losses on social media and trading forums. Many investors expressed their alarm at the sheer volume of trade activity and the drastic changes to their portfolios. Monitoring alerts triggered by exchanges indicated unusual trading patterns associated with Apex's algorithms, leading to increased scrutiny from regulatory bodies. Minor media mentions began to emerge, framing the incident as a potential glitch in the growing reliance on algorithm-driven trading. As the day progressed, the situation escalated further. Apex Trading Solutions attempted to stabilize the market by directing assets into less liquid stocks, which simultaneously deepened liquidity concerns. The more the algorithm recalibrated to the market's diminishing confidence, the more erratic its behavior became, leading to additional sell-offs. Back within the company, meetings initiated by the management attempted to garner collective insights on stopping the cascading effect. Yet, miscommunication about key parameters meant that decisions lacked the necessary coordination to reverse the damaging trend. Multiple systems continued to operate under flawed assumptions about both market conditions and their interdependencies. With stock prices plummeting, trading volumes surged, creating a paradox where diminished stock values increased algorithmic trading activity through panic selling. The trading algorithms became trapped in a cycle where the rapid sell-offs created an environment of fear and uncertainty, further compounding the problems. Regulatory controls proved insufficient in managing the velocity and volume of trades, revealing significant loopholes in market oversight that strengthened the vulnerabilities of automated systems. As executives sought to keep senior stakeholders informed, the situation destabilized beyond their control. External market conditions shifted sharply. Investors began pulling back their capital in fear of broader systemic risks, fueling further market sell-offs. Despite ongoing efforts to stabilize the algorithms and to halt the trading activities, the minimal impact led to heightened anxiety among leadership teams. News agencies and financial analysts quickly picked up on the severity of the incident, yet misleading narratives began to emerge, complicating the ecosystem of information surrounding the event. By the end of the trading day, Apex Trading Solutions had to confront the full scale of the situation, with billions in market value obliterated and a clearer picture of systemic vulnerabilities unfolding. In response, off-the-record discussions began circulating about potential ramifications and accountability, hinting at an impending investigation. The actions taken or omitted by Apex were under intense scrutiny. As communications became increasingly urgent, the first reactions from industry regulators were anticipated, marking only the beginning of a complex response to a crisis that exposed the fragility of trust in automated finance at its core. In the following days, Apex Trading Solutions launched an internal investigation into the incident, aiming to trace the cause of the algorithm's erratic behavior. Teams were assembled, and source code for the trading algorithms was meticulously examined, leading to the identification of a critical flaw related to the algorithm's predictive modeling that had been rushed into implementation just weeks prior. The decision to push for an update without comprehensive testing in a production environment became a focal point, highlighting significant miscommunication among developers, traders, and management. Simultaneously, trading volumes across global markets saw a dramatic decline. The S&P 500 experienced continued volatility, with a recovery effort hampered by the ongoing mistrust from investors. Apex's client base grew increasingly restless, with many investors approaching their financial advisors to discuss legal recourse. Reports indicated that over 100,000 users were directly affected, many facing severe losses that averaged 30% across their portfolios. The financial loss extended beyond individual investors. Institutional investors, including pension funds and hedge funds, also reported substantial drops in asset values directly correlated with automated trading activities. Industry analysts estimated that the total financial impact could exceed $500 billion across various platforms, disrupting financial markets globally. The persistent nature of the trading disruptions culminated in widespread outages on several exchanges, leading to increased fears of market manipulation connected to Apex's algorithms. By the end of the week, as the dust began to settle somewhat, Apex's executives faced mounting pressure to account for the chaos. Regulatory authorities, alarmed by the implications of the algorithm-induced sell-offs, commenced formal investigations. The SEC issued initial subpoenas to Apex Trading Solutions and related financial institutions to gather evidence regarding compliance failures and potential violations of securities laws. Legal experts anticipated that this investigation could lead to substantial penalties, as well as criminal charges depending on the findings. In the ensuing months, the company became embroiled in a legal minefield. A class action lawsuit was filed by affected investors, claiming negligence and misrepresentation regarding the safety and reliability of the trading algorithms. Internal communications, which revealed warnings from software engineers about the potential risks of the rushed update, surfaced as key evidence in the proceedings, indicating that management had ignored crucial red flags. Meanwhile, Apex initiated a series of emergency changes, including the complete suspension of affected algorithms and the implementation of an enhanced algorithm review process. However, by this time, trust had eroded deeply within the investor community. The firm announced a restructuring of its internal regulatory compliance team and pledged to improve transparency moving forward, but stakeholders remained skeptical. The exposure phase extended beyond legal filings. Journalists reported frequently on the crisis, delving into the algorithms that had precipitated the crash. Investigative pieces highlighted the broader implications for the entire financial sector, emphasizing systemic flaws that had long been ignored and the rise of algorithmic trading as a central model for market interaction. The existing protocols for algorithm approval were called into question, and many experts argued that a reevaluation of algorithmic trading regulations was urgent to prevent future catastrophes. In the following 6 months, the repercussions of the incident reverberated throughout financial markets. Apex Trading Solutions faced not only the legal struggles, but significant reputational damage, leading to key departures within its executive team, including the resignation of the CEO. Firms such as Apex began reevaluating their risk management frameworks, leading to a paradigm shift in how algorithms are developed and monitored across the industry. As the situation unfolded, secondary investigations kicked off involving exchanges and other trading platforms that worked in tandem with Apex. Law enforcement was drawn into the case, with algorithms reviewed under the lens of criminal fraud due to the cascading effects of the trading failures, resulting in accountability measures against not just Apex, but also several partnering entities whose systems interfaced with the flawed trading model. By mid-2024, following a lengthy period of litigation, Apex Trading Solutions reached a settlement with plaintiffs for approximately $200 million. The company, however, could not recover from the damage sustained. It declared bankruptcy in late 2025, leading to a shuttering of its trading platforms and services. Significantly affected regulatory policies emerged from this incident, resulting in a comprehensive review of algorithmic trading regulations by financial authorities worldwide. As a measure to restore investor confidence, new mandates were instituted requiring greater transparency and accountability concerning automated trades. Ultimately, the systemic flaws exposed during this crisis reinforced a wider scrutiny on algorithm-driven trading practices, underscoring the need for more robust oversight in an increasingly automated financial landscape. Final status. As of October 2025, Apex Trading Solutions filed for bankruptcy and ceased operations entirely,